Well, greetings and welcome to the Investment Strategy Brief for March 2024. Hey, right now in the environment, there's just a ton of optimism out there. There's views that the economy is going to grow really robustly this year. Markets are up a bit. And honestly, in this kind of environment, I kind of challenge myself and my team to think differently. So one of the things we want to get into in this episode is watching for a slowdown. What are some of the things that we're looking at to see if we can see a slowdown unfolding? Now, this optimism is sort of captured in a way in our Outlook. Outlook 2024, Embracing Change. Recall that we basically talked about the fact that there's lots of change going on, but we can optimistically embrace that and look for opportunities. And so, whether it's things like the geopolitical tensions all around the world, the elections that are happening globally, which we'll get into, higher debt, higher interest rates means higher cost of debt, the structural effects of the reopening of the pandemic that's still going on, and then, of course, the optimism is kind of anchored in artificial intelligence, what's been going on as it relates to the rollout of further AI capabilities and how that's transforming things. And so, kind of getting into it, recall that we think about the AI type topic as part of a broader work on long-term themes. So we've got productive competition, the idea of the new consumer, shifting demographics as generations kind of come and go in the economy, the idea of strategic resources and how that's all taken care of, and then the fourth industrial revolution, which is the idea that technology is kind of blurring the lines between the physical and digital worlds. And think of it as, in some ways that topic of AI is sitting in the fourth industrial revolution bucket, but honestly, it's spread around all these different themes as we see things unfolding. And, as we talked about last time, we did sort of pen an article in this Outlook report about AI, what it is, what generative AI is, the economic impacts, so the shift in the labor force, the increase in productivity, the fueling of competition, and so, then we look at the investment opportunities, the enablers, what are the companies that are helping with all this, get it all done, like semiconductors. Then there's the innovators, sort of existing businesses looking how to use AI to do things better. And then the disruptors. Hey, we're going to disrupt a line of business, a sub-industry or an industry. And this is all against the backdrop of lots of data being created every day. That's what AI is learning on. The idea that the workforce is going to change. So McKinsey did a study showing that 1/3 of the hours worked today could be automated by 2030. That's a big jump in a short period of time. And what's really intense is, the learning is happening on computers. So the fastest computer today is just a fraction of the speed of a quantum computer. And as those computers come online, think of it as the AI being able to learn faster. So a real jump in sort of productivity when that were to occur. So that's all the optimism. And basically what we're saying to ourselves is, look, let's look for the elements that might be feeding into a slowdown despite all the optimism that's going on. And so when we sort of take a step back, of course, one of our anchors is this idea of fiscal transition. So since the financial crisis, over $5 trillion more in debt for households, over $8 trillion more in debt for companies, and almost $25 trillion in debt for our government, against an environment where interest rates, in this case is measured by the 10-year Treasury yield, are up well above where they were on average after the financial crisis and certainly during the pandemic. But importantly, with the market's view that interest rate levels are going to remain elevated for the next couple of decades. So that means the consumer, businesses, and the government, we're all going to have to figure out a way to basically get a better handle on debt. And on the fringes, we're going to see trouble. So against that backdrop, one really important category then is commercial real estate, which tends to be funded in part by debt. And when we look at sort of how the different segments of the commercial real estate market are holding up, one thing that jumps out is, not surprisingly when we think about it, is that office related commercial real estate has really rolled over. It's posted a negative return, and that's really been related to kind of the bottom line that we haven't seen the occupancy come back since the pandemic closings, right? So by one measure, here we happen to show this one Kastle Back to Work barometer, basically at just over 50% of occupancy. And so and we happen to show this against just consumer activity. So basically there's a lot of engagement back in the economy. But the bottom line is that people and companies haven't fully come back to the office. And that's notable, right? And it's sort of reflected in the commercial real estate. And so if you're owner of commercial real estate, you have to be mindful of that, and hopefully you have an asset manager that's making the decisions where to rotate in or out. But then, of course, it is also an influence on our banking system. So the banks are lending to commercial real estate. And so when we look at it through the lens of the size of banks, the top 25 banks basically have about 13% of their asset exposure to commercial real estate, but that's much more expansive for the smaller banks. So what you're hearing about is sort of the pressure that banks are feeling as we look at what's going on. And the bottom line is, in addition to the commercial real estate generally, with interest rates up, the longer dated assets have taken a hit within banks. So it does beg the question, almost like a top down and bottom up question about the banking system. So first, looking at top down, and by the way, we tend to follow both the Federal Reserve as well as, of course, Stifel's partner / subsidiary company KBW, a financial services expert. And in some ways, they both are saying the same thing, and that is at a higher level, when we look top down, systemically, the banking system is fine, right? The bigger banks are fine. They're kind of watching sort of the liquidity and the strength of the companies and all that. But when we look bottom up, generally things are fine, but there are some banks that are going to be under pressure or are under pressure. So the Fed, of course, is engaging with those banks, and inevitably we should expect to see some slowdown / some trouble for individual banks. And so, as an investor, one of the things I've thought about as I was preparing for today's episode is to say, look, as an investor, you want to understand how, if you're exposed to banks, basically how you're exposed. If you happen to have it in a managed portfolio, could be an alternative investment or a traditional separately managed account or a mutual fund, the bottom line is you've engaged experts to try to figure this out. And there's almost like the best thing you can do is sort of think about and reflect on the work they're doing on your behalf, right? And on the other hand, if you happen to own individual positions that you kind of have control over, right, where maybe over the years you've decided to make an investment in a regional bank, and you want to know, hey, I wonder how this thing's doing. Obviously, that's the time to call your financial advisor, have them dig. They'll have tools and resources and research available to basically dig into what's going on with those individual positions. And you just want to make sure you feel comfortable that as an investor you're not exposed to any of these trouble situations. And so again, that would be one point of specific guidance that I would offer. In any event, when I look out beyond the banking system to some other areas of trouble, the second one we've been talking about and writing about is the consumer. So we know that the consumer has been strong. It's been the driver. We've been the driver of better than expected economic results. And kind of the punchline is that's happened because of pent-up demand in the wake of the pandemic closings. It's happened because of excess savings from some of that fiscal support from the government going into the pockets of individuals that's built up excess savings that's being spent down. And then as the job market is reopening after all the closures and sort of layoffs, if you will, of the pandemic shutdown, there's sort of strong demand for workers that bids up, for example, wage growth, and the workers just generally have felt good. And so the kinds of things that we're watching anyway, number one would be the labor market. It's easing a bit. Supply and demand is coming into better balance. Those payroll gains are sort of at a lower pace. The wage growth is easing. And what we're seeing is sort of a shift where the consumer isn't going to feel, or the worker isn't going to feel quite as optimistic. Second labor-related topic is structural forces, really around participation. So generally speaking, the participation rate has been declining since, frankly, around the start of the century. And sort of the bottom line is what we see is more people retiring early. We actually see students staying in school longer. And that's just sort of lessened the labor force participation, which is more of a systemic, sort of slow-growing, incremental weakness, if you will, on the economy. So it's something we're mindful of. In any event, as it relates to the more day-to-day in this environment, we're watching things like retail sales. So the most recent report disappointed a little bit compared to the consensus expectations. Of course, we talked about rising debt, and you can see on this chart basically a little pickup in delinquencies. And so that's just something we're going to watch. Are we going to start to see stress in the consumer? Because again, the consumer makes up about 2/3 of the economy. And so we're watching for that slowdown, specifically in the consumer. Now let's switch gears and talk about a couple of the main areas that we tend to want to cover each month. One is sort of the economy, the Fed policy, and inflation, how that's all woven together. And most of us would likely know, many of you may know, that the most recent both consumer and price index, producer price index reports had disappointed. They were a little bit firmer than people would like, a little bit above the equivalent of the Fed's 2% target. And that's really caused people to realize, wait a minute, maybe the Fed's going to take a little bit more time to essentially cut rates, which has been our outlook. And in fact, when we look at things like the messaging from the December Fed meeting, the January Fed meeting, Chairman Powell's testimony to Congress, their speeches, essentially they've been saying the same thing. Yeah, we're eventually going to cut in 2024, but we've got to see good inflation data for a decent period of time before we start doing that. So again, what's super interesting to me is, essentially here's a chart that shows the Federal Reserve's forecast for the year-end 2024 Fed funds rate. And essentially, with their most recent summary of economic projections, they sort of reduced that. That was the signal, hey, we're going to cut a couple times, 2 to 3 times later in the year. And that blue line is based on futures, is the market's expectation. So the market's been expecting more than the Fed has been signaling. And just with this most recent news, this most recent learnings about inflation, have we seen the market's view kind of come back to the Fed's view, and honestly our forecast for year end, which is 2 to 3 cuts, quarter point cuts, sometimes starting around fourth quarter is what we're expecting. And so again, we'll have to see how it all unfolds, but market's kind of coming back to that view. Now, I mentioned that the economy has held up really well. We're sort of back to that long-term trend line. And in fact, when we look at the consensus view for GDP for 2024, as of mid-March, that's up to 2.1%. Which honestly is well above our forecast. Maybe we'll be wrong, but the bottom line is that seems very rich. And again, what we're expecting is for things to slow down a little bit. We'll see how that all unfolds. Now, turning to the market, sort of a similar pattern. Number one, as it relates to this activity with the Fed and inflation, the 10-year Treasury, for example, so it's sort of the rate, you can see 10Y on this chart, and you just look up, that green line was the end of the year. And where we are today is about, round numbers, about 4.25%. So rates have gone up just a smidge more as it relates to essentially this nervousness around Fed policy and inflation. And that, obviously has an impact on things. But ultimately, as bond investors looking forward, that means that yields are just a little bit more attractive compared to the beginning of the year. And so as investors, that's good. But when we turn then and look at the equity market, as we've talked about in the last at least episode or two, is that the equity market is a little bit frothy. It's a little bit overvalued, especially by traditional measures. When we look at PE, for example, on the S&P 500, it's a significant premium to the long-term 10-year average. And then when we equal weight that to take out the effect of the bigger tech-oriented companies especially, it's still, sort of reasonably valued. But anyway, long story short, of course, as I think we talked about last time, that's driven by the expansion, the growth of these bigger tech-oriented companies, and these are included in the top 10, for example, of the S&P 500, and you can see the PE ratio has really expanded on that block of the index. And the bottom line is well above the rest of the index, right? So you kind of look at that and go, whoa, those stocks are really, really overvalued. But when we look at it relative to growth, and this chart just shows us growth for in this case, the Magnificent Seven versus the rest of the index and the index overall, both for 2024 and 2025, you can see, for example, 2024, the expectation for earnings is that the Magnificent Seven is going to grow at 3 times the rate, 24% compared to 8% for the rest of the S&P 500, and a similar, or also a positive differential for the year after in 2025. So when we kind of adjust our PE ratio for that growth, we basically divide the two, you get what's called the PEG ratio. And by some lenses, given those growth rates, the Magnificent Seven still looks just a little bit cheaper than the rest of the market, which again is quite striking. Now, of course, it's all about those growth rates holding up and the risk that might not be the case. And so those are the kinds of things that we're sort of digging into. Now, when we look at the performance year to date, the kind of nuances here are that pattern last year of the big tech-oriented companies. So, for example, now we have the Magnificent Seven index up over 100%, 107% last year. Basically, started the year here in 2024 up over 15%. Both of those contributing to that top line, the S&P 500 over 26% last year and starting out the year strong. And so, the bottom line is, again, optimism built into the equity market. We wouldn't be surprised to see some softness, maybe some drifting down in the equity market given that. We remain long-term, of course, still very optimistic, but just recognizing we're setting up, especially if we start to see some indications of a slowdown, that the potential for the market to roll over and potentially move lower. In any event, 20 new highs here in 2024 for the S&P 500. And so, again, that's the kind of thing we're keeping an eye on. Included in that is this idea of looking forward. So as I've mentioned, we're watching things like the Fed policy, Fed minutes. We're watching things like, retail sales and inflation. We're keeping an eye on the economy generally, the geopolitical tensions around the world, elections that are coming up. And those are all things that are in our view as we kind of do the work we do. As it relates to the elections, I wanted to touch on 2 things. The first is now we're here in the U.S., basically in phase 3 of what we think of as our presidential election cycle. We're headed to the general election, meaning we know who the candidates are going to be. It's a rematch of 2020. And so we can, as voters, kind of dig into the trade-offs, pros and cons of each candidate, make our decisions, what we're going to do, and then things will unfold as we come to November and see how things land. Obviously, as it relates to Congress, a lot in play. The various majorities are very tight. The House gets recontested. Quite a number of seats in the Senate, a few more for Democrats being recontested than Republicans. So we really can't tell at this point, I don't think, where the power is going to settle, right? And we'll talk more about that through the year. Now, when we look out beyond the United States, there are a lot of different elections going on, or as I've mentioned, around the world. And so one of the things we do is to look for key themes. And, not surprisingly, one key theme is the idea of economic opportunity. So you have basically people running in elections talking about things they'll do to improve the lot of individuals in the country and sort of improve the economy there. But that does translate a bit to a view of sort of protectionism. Hey, let's take care of our people. And that, of course, in turn influences trade partners and international relations. And so we're kind of watching things through those lenses. And, we've identified as examples 5 that we've kept an eye on: Taiwan, Indonesia, India, Mexico, and the EU. Part of it is around how our relationship with these countries or areas might change relative to China, right? We're competing with China in a global trade sense. And what's a good example of that is when we look at GDP growth, you can see on the left side of the page today the top 7 countries by GDP. When we look to the right out to 2050, this idea of China being number 1, we're number 2, India number 3, Indonesia number 4, and then Germany, Japan, and Brazil. And so the punchline is, even today, when we're looking at a country like Indonesia, it's a very interesting one in the sense that they've got economic growth. They're going to kind of come into a stronger seat in the global economy. And today they sit there and say, look, we want to be strong trading partners with both the U.S. and China. We don't want to pick a side. We're going to develop our relationships in both directions. And for example, as it relates to China, they've been participating in China's Belt and Road Initiative. And so, bottom line is that that's something we got to keep an eye on. And, as things unfold, we'll report on that. I want to close with a couple things. One is we will keep in mind our various scenarios. We have a bull scenario, which we kind of feel like we're experiencing a lot of optimism, and then a bear scenario. If things roll over even more negatively than we've been talking about today, that could spell trouble. But right now, again, on that side of things, we're not quite seeing anything quite that negative, but we'll keep an eye on it. And then finally, Stifel guidance. Check out stifelinsights.com. This video, a podcast that relates to it, a deck that relates to it. This deck is available there, along with a bunch of other work that we'd invite you to check out. So thanks so much for viewing this episode, and we'll catch you in April. Thank you.